Hello, and welcome to the first video from our preferred stock series. My name is Danny Burns. I'm an associate in the Thompson Hine New Ventures practice. Today, we're breaking down one of the most important documents in the world of startups and venture capital, the term sheet. Understanding the term sheet is crucial for any successful funding round. A term sheet is a non-binding summary that outlines virtually all of the key elements and conditions of an investment. Think of it as a blueprint of the deal. It sets the stage for the final legally binding documents. Let's look at some of the most important issues that you'll find in a term sheet. Number one, valuation. While technically this determines how much your company is worth, what's most important is that it suggests how much of it you'll give up in exchange for this round of investments. Number two, liquidation preference. This clause spells out how the investors, founders, and other stockholders will get paid out if the company is sold or liquidated. Investors often want to ensure they get their money back before anyone else, which isn't considered unreasonable given the risk they're taking to invest in your company at this early stage. Number three, board of directors. Once a company raises outside capital, investors will want to be sure regular board meetings are being held so that they're aware of the company's progress. In addition, the term sheet will specify how many seats investors and founders get on the board and whether or not there will be any industry experts or independents on the board. Number four, protective provisions. These are special rights that let investors veto certain actions like selling the company or issuing new shares. It's a way for investors to protect their interests, included in virtually all venture capital investment transactions. Number five, founder vesting. Vesting schedules ensure that founders earn their shares over time, encouraging them to stay and build the company and giving investors comfort that the founders will do so at least for as long as their invested capital is expected to last. Number six, information rights. Information rights are a standard provision in most term sheets and give investors the right to receive certain information about the company's performance and operations. Typically, this includes the right to receive annual, quarterly, and sometimes even monthly financial statements, as well as the company's annual budget and board meeting materials. Number seven, anti-dilution protections. This protects investors if the company raises money later at a lower valuation. If that happens, it adjusts our liquidation preferences so that they're not excessively diluted as a result of the down round. Number eight, exclusivity. This means the company agrees not to speak to other offers for a set period while the deal is being finalized, giving investors confidence to proceed with the transaction. Importantly, this exclusivity provision does not restrict the company from accepting additional investors into the same financing round proposed by the lead investors. There are many other provisions found in a standard term sheet, like dividends, conversion rights, registration rights, right of first refusal, co-sale, or tag-along rights that have become so customary that they generally are not worth negotiating. Unless a term is unusually out of market or could truly harm your interests, you can usually deprioritize these provisions. Of course, there are always exceptions and special situations, so ensure that you consult your legal counsel if you have any concerns. But for most deals, your focus should stay on the key terms we just highlighted. Our New Ventures team is here to help you. If you are considering a price equity round or have additional questions regarding term sheets, do not hesitate to reach out to your New Ventures attorney. Thank you for watching and stay tuned for our next video in our preferred stock series.